What is up everybody, Gifford here and welcome to another stock video where I try to make money from the stock market. In today's video we're going to talk about two new companies because I got an email from Sharesies. When this email was sent out it was way too short for me to even decide whether or not I was going to invest in it. We're going to go over the email and their proposed share placements in the NZX. This isn't financial advice and I haven't talked about these companies before. These are two brand new companies that I'm thinking of investing in. I'm going to share with you my thought process as we go over my first initial basic analysis. As always, please hit like on the video to support the channel, and if you like investing, feel free to subscribe. With that said, let's get on with it. Here's a screenshot of the email I got, and this first company is Radius Residential Care. Ticker symbol RAD. So reading here, Radius Residential Care has announced a share placement and you can apply to take part through Sharesies. Applications to take part through Sharesies close at 4 PM today, Thursday, 8th of July 2021. You can find a link to the application at the bottom. A brief description of what a share placement is, and a share placement is when a public listed company gives investors the opportunity to buy newly issued shares at a set price as a way to raise capital. And the share placement price that they're offering is 60 cents per share. And the second company is called ERD Limited, ticker symbol ERD. So this one gave me a little bit more time, but I still didn't have time to look into this company because it was too quick. But these ones are being given to the shareholders at $5.58 if they want to go on this share placement. And a good thing to note that if you really like these companies and their share placements, you won't be charged the Sharesies transaction fee. So before we look into these two companies, there's two main reasons why a company would want to do a share placement. They want to raise capital, but basically what it does is it adds more shares into the available shares that you can buy from the company already, which means they dilute the other shareholders. And it's very important to understand why the company is raising money, because they're actually wanting to grow and invest in infrastructure, or they're trying to pay down debt. So going to my trusty Simply Wall Street, we're going to have a look at Radius Residential Care. So hoping you can see the summary, and it reads here, Radius Residential Care Limited provides health and aged care services for elderly and disabled New Zealanders. So looking at the risk, it has no financial reports. It has been a volatile stock for the last 3 months, and it also does not have a meaningful market cap, which means it's pretty low at 141 million. So having a look at the share price action, and it doesn't look very good. So these guys have only been around very recent, end of December 2020, and we can see it's just been going downhill. They opened up at $2.30 and now they just kept on declining. Quite a heavy decline here, down to $1, so that's not a good sign. So having a look at future growth, they've been given a 6.4% again. Many red flags here, and then we have a look at the past performance, which is 7.5%, and it's just all red ticks. So it's just a whole lot of red crosses, meaning they don't have information about this company, or it's not readily available, or they haven't given it out. So moving on to financial health, and it looks like again many red crosses, many red flags for me to invest into this company. It doesn't look like they have much information about them at all. So there's not a lot of information on Simply Wall Street, so we've come here to Yahoo Finance just to have a look at these companies' overall statistics, and we can see the market cap is 144 million. They don't have an EPS and they do not have a PE ratio, which means they aren't making money, but they do have a very small dividend. So just a spoiler alert, just looking from those metrics right there, I'm not going to be investing in this company. Also in my circle of competence, aged care homes I like, but this one is just not enough information. So, but anyway, continuing through, I want to have a look at their financials reporting. So I've gone to their website here, which is radiuscare.co.nz, and gone to the Investors Centre. I'll put that in the link below just so you guys can see whereabouts I'm getting this information from. So I'm now in the FY20 annual results call transcript. So we're now at the statement of comprehensive income, and we've got here financial year 2020 and then financial year 2021. So we can look at the total revenue for 2021, which is 122 million. Remember, you got to add another 3 zeros onto here because it's 1,000, so therefore that makes that into a million. We can see that the previous year they did 114 million. So the gap between these two here, it hasn't really increased that much. So this is one of the reasons why I wouldn't be investing. There's just not enough growth for me here. So because it is a dividend paying company, you're going to lose a lot of that growth because they have to pay out those dividends. If we come back lower, we can see the total expenses, and in financial year 2020 they were 117 million, and for this year 2021 they were 124 million. The brackets means that it's a negative number. So when we come down to the bottom, we can see the total comprehensive income, that in year 2020 they did $2.8 million, and in 2021 they also did $2.809 million, a little bit less. So we're going to cut it short there for RAD stock. The revenue of 126 million with the expenses of 124 million means that $2.8 million in profit is just not high enough. They've also got to pay dividends out of that, and the margin for the business is just not high enough for me to invest into. So that's going to be a big no, and we're going to move on. So the second company we're looking at here is called ERD, and that's ticker symbol ERD. So looking at the summary, ERD Limited provides electronic onboard units and software as a service to the transport industry in New Zealand and internationally. So this is pretty good. It's in the technology center, so I have a little bit of knowledge about this company and I might feel comfortable investing in them. So having a look at the rewards here, they're trading at 6.6% below our estimated fair value. Earnings are forecasted to grow by 57%, that's pretty good, and earnings grew by over 100% last year. So we can see that the market cap is just over $500 million, so that's not too bad for a New Zealand company. So we can see from the share price that over the last year they've been steadily increasing, and if you invested in them, you've probably done really well. If we have a look at the last 3 years, they haven't been too bad, pretty flat, but really the last year has been the growth. So the current Simply Wall Street valuation has them valued at $6.96, and the current share price is $6.50. And remembering back from the email, the share placement that you're getting with Sharesies is $5.58, so you're actually getting a pretty good discount of almost $1 per share if you really like this company and you want to invest in them. So having a look at future growth, we can see here that they've got it at 57.9, and currently their earnings is at $2 million. So it's a $500 million company with earnings of $2 million, and if we move forward about 5 years from now, the expected earnings is $16.6 million. So just from my initial feeling, $16.65 million for a $500,000 company is a little bit too expensive, even when we're looking 4 years ahead. So looking at the financial health of this company, it's very good because they can meet their short and long-term liabilities. And the other thing to mention is that the ownership breakdown, it's got institutions at 38.7%, so it's a very stable company, and the public owns the other 38.2%. And having this big institutional base means that the company is going to be really stable. You get this because the company is actually making money. So moving over to Yahoo Finance, we can see that the market cap is $540 million, and they've got a pretty high PE ratio of 244. So remember, value investors, they want the PE ratio to be around about 10 to 30. So depending on the business, the PE ratio doesn't really matter that much, especially for me as well, because I'm into growth stocks. But this here really shows that it is quite overvalued for this type of stock for the amount of money they're making. So we can see here that the earnings have been going up steadily since 2018, so that's real good for the company. And these here are the analyst recommendations, but for New Zealand stocks, I would not take them seriously, so I don't even bother looking at it. So this looks like a pretty solid company. So now I've taken it further and gone to the investor relations page. I'll put the link in the description just if you want to have a look at it, to look around yourself. But what I'm really interested in is about their company presentations and their financial reports. So we're just having a look at their last financial reports here, which is 2021, 31st of March, so that's the last 12 months. So this report is 40 pages long, and we can just see here it's just company updates and also some metrics of how well they've been doing with regards to revenue, EBITDA, and operating expenditure, and just a summary of their growth as well as some of their new products and how they're going to be expanding in the New Zealand transport industry. So I've just gone over to another report, and this one here is 82 pages long. I'm not going to go over it. There's a lot of information on here, but this is the annual report 2021. So to summarize, the first company was pretty terrible. There wasn't enough information and there wasn't enough potential I saw in the company to invest in them. So that was a straight out no after that basic analysis. So this moves us on to the second company, ERD, and will I be investing in this company? So the answer is no, and the main reason is because the PE ratio is way too high for me. It has a positive PE ratio, so they do make money and it looks like a solid business. But right now, with regards to its market cap and therefore its share price, it's just too expensive. So while the share price is only around about $6.50 and the share placement is $5.58 at a discount, what you're actually paying for is those $2 million earnings per year onto a company worth $500 million. that's just too small. So the share price is small, but the market cap is actually pretty big because there's a lot of shares of them and they're going to get diluted again. So just my opinion and not financial advice, what's actually happening to me is that a lot of growth has been already baked into the $6.50 or the $5.58 share placement price. So for me to invest in this company, I would need a very heavy discount on the share price, dropping more than 50%, and even then I'm not even sure if I'm interested in the business enough to own them and to really learn about them. I just don't see a potential, that explosive growth where I could be investing my other money into the companies that I already know. Well, that's enough for me today. Thank you for watching. As always, safe investing in the stocks that you buy. So I hope you found value in that video and also going over the thought process of what I'm thinking about when I buy these companies. Just remember, my experience in the stock markets is still only a little over a year, and although I've done pretty well, it was a very good year to have done in the stock markets. It's been nice to talk about 2 new companies instead of the usual ones that I talk about, but I am looking for investments that is going to multiply my money 5 to 10 times, and I just don't see it in these 2 companies, and that's just my personal opinion. So if you still like these companies, feel free to invest in them, have a look at them in detail, because this is just a basic analysis of what I've done. May the gains be with you, and if you want to hear more from me, you can follow me on Instagram. Otherwise, I'll see you on the next video. Goodbye.